Our view is that the macro outlook is positive. We're in an environment that is growth friendly, and that's good for equities overall. So why is that? Well, firstly, we've got interest rates being cut, but the main message from the data seems to be that inflation is under control, that the labor market is okay, it's not too bad. If it gets worse, the Fed, I think, would cut more. And it's set up for a pretty decent environment in the first quarter of next year. On the back of that, we have the big, beautiful bill, which is basically going to be more supportive growth. And also, we just have the US economy doing okay. And, the CapEx in companies is improving. AI has been a big driver, not only of returns of markets, but also of spending. And really, these hyperscalers have been hiring, they've been spending money, and that's positive for the economy. I think the big difference going into 26 rather than 25 is we don't have this huge headwind of what's going to happen with tariffs. Are tariffs going to affect the economy? We obviously have a number of negotiations that always happened, and there are still a few that happen. So, for instance, we went into 25 expecting China and Mexico to probably be the worst affected. Actually, they've got away quite lightly in one way, particularly Mexico. But India and Brazil have been on the other side of it. Now, we think that Brazil's beginning to see tariffs come down, but India is still out there. And it's probably more driven by politics, to be honest, than economics, and probably not that important over GDP because the Indian economy doesn't really export that much, but it's still there. I think the great thing about the outlook for Asia and emerging markets and Japan for next year is there are many drivers. It's not just AI. But what we probably will see in AI from an Asian perspective is that the hyperscalers continue to spend, and Asian semiconductors and supply chains are a beneficiary. We also have, I think, a parallel sort of CapEx spend just about to happen in China, which is very different cycle, very different supply chain. So that's obviously very positive. One theme that has been building and brewing under the surface, which really is expanding across most of Asia, is corporate governance reform and value up, etc. It was started many years ago in Japan. It took years to pick up. It's now really big in Korea. We're now beginning to see it in Singapore. I expect other markets will pick up. I mean, the models there, China, certain areas are doing it. But, it is a theme there that is very, very positive, because one of the weaknesses of Asia over the last 10 years has been earnings. And what Value Up does is produce better earnings. And so that's really, really positive. Beginning of the year, we still remain positive on North Asia. So I'll say that South Korea, Taiwan, Japan. And there's one aspect that really drives that. It is still AI, the spend of AI, semiconductors, some of those areas connected with semiconductors. And, but, within that, obviously Japan has other drivers with the value up. The market's relatively cheap. It's been underinvested by global investors. And so we do see, not the end of US exceptionalism, but we do see diversification happening more. And Japan's a huge market that people feel comfortable with. Taiwan, probably more underweight there, but being very selective. So we don't like the domestic economy, and the domestic stocks like we have done in 2025. But we do see there's some world-class companies there, and stock-specific opportunities to really benefit from AI and that whole supply chain. On the other hand, Korea has multiple drivers. It's got that big semi-exposure, which has done well in 25, but we still see it continue in 26. because we know the capex of the hyperscalers is going to continue. But then it's got the value up reform program. It's also got a wider industrial area which is benefiting from cyclicals. It's much cheaper, so it's under 10 times earnings. So it's actually half the valuation of Taiwan. But then we have had, because of the whole tariffs, because of US-China relations, even though we're saying US-China relations have improved, you know, it's going to be very difficult for a lot of those sectors in China to win US orders. And Korea is a natural beneficiary, whether it's in nuclear, whether it's in shipping. And then you have the defense element that, you know, Korean companies are first class in technology, in engineering. And that's obviously been a very, very positive booster. The real disappointment in China from a sort of top-down basis last year, or sorry, last year as in 2025, has been the lack of earnings growth. And I think there's two reasons for that. You know, one is that consumption hasn't been great. And that's really been a function of lack of labor pickup and lack of wage growth. And the second angle has been property. Property still continues to be tepid. So the real growth in China has been through industrials and very funneled to certain sectors. The other thing that's been hurting earnings has been the competition in e-commerce companies. So you've had huge competition with companies trying to go for maximum market share and just diluting each other. And that's had an impact on a lot of major companies. So we do think going into 2026, some of that competition will soften and generally overall earnings will be better. So we're quite positive on the Chinese market, but we need to be quite specific, especially in the beginning, to focus on those areas where we are seeing either potential for re-rating because it's a new theme or it deserves a higher rating relative to global sectors, or it needs to be driven by earnings. And so AI, I think, is just beginning in China, but it's not all companies are going to do well. We have to pick the winners. E-commerce, there's still some great companies there, but we have to pick the ones that are winning. It's not just about buying the sector. And then financials, we have a preference for insurance companies. Something we've been talking about for the last 2 years, actually, is really this structural pickup in insurance as China wants to improve the savings rate and improve the sort of pension and social welfare systems and get more savings away from property. There is less reason to be negative on India going into this year as there was last year. Firstly, a lot of foreign investment has come out. Secondly, earnings have been downgraded and they're now beginning to stabilize. And thirdly, the government has done quite a lot to try and improve growth, whether it be cutting GST, goods and service tax. That was quite a surprise, and that's a pretty decent, boost for the economy. Secondly, on top of that, they've been cutting interest rates, and thirdly, they've been spending a lot more money. And then I think finally you've seen a bit more deregulation, particularly in the financial services area. And this has led to pickups in isolated consumption, particularly in the rural areas, and stocks like the autos have benefited, and quick commerce and e-commerce. But it hasn't really moved the dial in overall consumption. So really our outlook is to be more constructive on the financial areas, rates coming down, safe sectors underperformed, probably under-owned, some selective consumers, discretionary rather than staples. Telcos, I think there's quite a few catalysts there. We're getting more favorable on IT, having underperformed, more on maybe the mid-cap areas, but we are still wary overall as a market on just the overall level of capex and that engine of growth. I'm scratching my head on ASEAN because the valuation levels are incredibly good, and it should be a market that benefits from what's happening in global macro, particularly rates coming down. But politics has made currencies weaker, stock markets down, and has begun to affect the macro. And so, we would look for, there's no immediate catalyst, but it's certainly an area where we will stay underway but look for opportunities as times arise and see turning points, because you can't ignore valuations in the longer run. Europe, some of the Europe plays have done well, but there's still no reason why not to buy them, as in Eastern Europe and Greece. Cheap valuations, buoyant by Europe, rates coming down, loan growth picking up. I think South Africa is an interesting area. It's still quite cheap, but LATAM was going to be my favorite market or area for next year. It's done well this year, but particularly Brazil. We had 3 catalysts that we thought would really make Brazil one of our favorite markets for 26. And that might still come through. The catalysts were political change, interest rates coming down and looking at 350 to 400 basis points of interest rates, which is huge. And that then leads to switching from fixed income into equities for local funds, and the cost of capital for these companies coming down. And a lot of companies and businesses can benefit from rates coming down, because there's a really punitive level of interest rate at the moment. And the third was then fiscal change, which obviously relies on politics. But the shenanigans that have happened, where it's not really clear, with Bolsonaro's son putting his hand up for the presidential role, which it might be more political sort of chair swapping, but it does just raise that political risk. And things in Brazil short term can go wrong, because political risk can lead to currency volatility, which then leads to that story of interest rates not going down. And so we just have to be careful there. We do see that, despite valuations being reasonably high relative to history, sort of above long-term averages, we do see a number of catalysts for emerging markets to perform this year. There are multiple drivers, as I've mentioned, plus we do feel that the attractiveness relative to other markets is strong, and that should see flows coming in. And global macro initially should be quite supportive, with US rates coming down, potentially weaker dollar as the year goes by, and US growth really favouring cyclicality and risk on.